start. My name is Connor Zerb. I'm joined today by my colleagues Evie Koslowski and Santiago Diaz. We are Team R, and we are recommending a hold on Coca-Cola with a price target of $57.70. A brief summary of our investment thesis. They revolve around the North American franchising efforts of Coca-Cola, the product development of Coca-Cola, and then the emerging opportunities in emerging markets. So with that, I'll pass it over to Evie Koslowski to do the company and industry overview.
So Coca-Cola is a worldwide non-alcoholic beverage company serving 1.9 billion servings per day. They operate in two segments, concentrate operations as well as finished product operations. In their concentrate operations, they earn revenues by producing syrups and concentrates, which are then sold to third-party bottlers. In contrast, their finished product operations are earn revenues by producing the same syrups and concentrates, but instead of selling to third parties, they are mixed and bottled in-house. 32% of Coca-Cola's revenue comes from North America. However, the company does have initiatives in emerging markets, and this can be seen in the 3% growth between the 2018-2019 finished product operations, which are predominantly used in emerging markets. Moving on to the industry overview, Coca-Cola is pretty hard to beat as far as brand name, as you can see by the 30% market share in the beverage industry of the $1.6 trillion industry. Coca-Cola also has leadership positions in individual beverage segments, including carbonated beverages, dairy and plant, ready-to-go coffee and tea, as well as bottled water. They also have the number 2 position in energy drinks, right behind Monster, which they own 17% of. The two biggest risks in the beverage industry is competitive rivalry as well as the threat of substitution. And then going into some trends within the industry, the two major ones, the first one being growth in developing and emerging markets. You can see there's plenty of room to grow because in the first graph you can see that there's about 30% of all beverage consumption in developed markets is from non-commercial, whereas that number is 70% in developing and emerging markets. So there's plenty of room to grow in that segment. The second major trend is a trend towards a healthier consumer, and so companies are taking advantage of this trend through mergers and acquisitions, which you can see through Coca-Cola's acquisition of Costa Limited, which is a coffee company.
So looking at the financial analysis of Coca-Cola with the tear sheet that we built out, before we get too far into it, I want to note the metrics calculated in the left-hand column here were calculated using the closing price on Thursday and not Friday. These would be slightly different if we were to update that with the one-day difference. That being said, looking at top line for Coca-Cola, it's actually grown at negative 4.3% compounded annually since 2010. While this looks bad at a surface glance, it's important to understand that this is the result of a major structural change in the business of Coca-Cola as it acquired the North American bottling operations of Coca-Cola Enterprises and then divested those at the end of 2017 and 2018. That being said, they've been able to grow their operating margin or their operating profit throughout that time, leading to the increase in operating margin. Looking at the profitability metrics highlighted in the middle of the slide, ROA, ROTA, ROE, and ROIC have all exploded since 2017. And this makes sense because Coca-Cola no longer has to report these bottling segments, which are capital-intensive, low-margin businesses. So as a business now, Coca-Cola is much more profitable than it was in the last several years. Finally, looking at the net debt to EBITDA coverage, it might be concerning to see the shift from 0.8, 1.8 times to being as highly leveraged as 4.7 times in 2017, but this is because when Coca-Cola acquired these bottling operations, it assumed the debt of these bottling operations on its balance sheet and kept that debt when they divested them. That being said, they've been able to get net debt to EBITDA down to a comfortable 2.4 times, and we're not worried about this debt. It's very low yielding debt with long maturity dates, and the interest coverage is almost 33 times, meaning that Coke is very capable of paying its mandatory debt repayments. So that being said, it should be no surprise that our first investment thesis is what we believe the successful North American refranchising. So throughout its history, Coke has gone through various phases of owning and divesting or restructuring its bottling operations. And you can see the top half of the slide, it's kind of an abbreviated timeline of what Coke has done in North America from 1980 to present day. So the block of time that we're focusing on is from 2010 to 2018, as I said, when Coca-Cola purchased the North American bottling operations from CCE and then divested them. What this has created is a much more regional distribution network that we believe is more efficient, not only for the bottlers themselves, but for Coca-Cola. Again, kind of to reiterate what I talked about in the last slide, its operating metrics and return metrics have improved drastically, and not owning these bottling operations allows Coca-Cola management to focus on the growth opportunities that we'll talk about in our next two investment thesis.
So our second investment thesis involves diversification of their product portfolio. As you can see, about 60% of their revenue comes from sparkling soft drinks. But with a trend towards a healthier consumer, the sparkling soft drinks market, so the US per capita consumption of sparkling soft drinks has been on the decline, has a negative 1.65 compound annual growth rate from 2010 to 2018. So with this trend towards healthier consumers, there is a decline in carbonated soft drinks, but there has been growth in healthier options such as ready-to-drink coffee, bottled water, and added value water, as well as an increase in energy drinks. So Coca-Cola is taking advantage of these growth segments with their acquisition of Costa Coffee as well as Fairlife. They have also had some product releases such as Coca-Cola Coffee, AHA Sparkling Beverages, Flavored Smart Water, the ready-to-go coffee from Honest, as well as Coca-Cola Energy.
So moving to our third and final thesis point, it revolves about emerging markets being able to offset the decline in carbonated drinks consumption while also providing growth opportunities and profitability for the company. Looking at the composition of these markets, about 80% of the population is in an emerging market, but only about 30% of the commercial drink industry is commercialized, thus allowing a lot of growth opportunity for Coke as consumer spending patterns tend to narrow, imitating developed markets due to rapid globalization and urbanization of these areas. This urbanization is projected to reach about 2/3 of the population by 2050, which as a consequence would increase the middle class, mainly led by the Asia-Pacific region. Spillover effect of this middle class increase would be an increase in household disposable income and consumption by spending. As you can see, China itself is projected to outperform the US economy. If on top of that, the emerging markets makes it a very attractive opportunity for every global brand. And the way that Coca-Cola is currently being able to capitalize on this, currently 31% of the unit case volume comes from Brazil, Mexico, China, and India. And then also being able to resize their bottles, which I think is something very important because providing smaller sales unit allows two things. One, it reduces the price, which allows that aspirational lower income consumer to be able to actually afford what they perceive to be a luxury product in those regions. And two, it makes each fluid ounce of Coke more profitable, thus improving our margins. So with that being said, we're moving over to our DCF. We calculated a 6.1 WACC for a discount rate, a 3% general growth rate, and we've had a 32% EBIT margin expansion for our final projection, giving us a value per share of $62.99, implying a P/B of 0.87. When analyzing the competitors, we understand that any beverage company is a competition for Coke, but we decided to focus on some of the four biggest competitors in the industry being PepsiCo, Keurig Dr Pepper, Constellation Brands, and Monster. What we did is we projected a 12-month forward net income and EBITDA for Coca-Cola, and then using a historical 3-year trailing 12-month universe multiple median, we were able to yield a value of 55 with 83 cents and $48 respectively for PE and EV to EBITDA multiples. And now Connor is going to touch on how we're able to blend this together for valuation.
So as much as we would like to just use DCF valuation for Coca-Cola because of its attractive qualities, like it's a very mature business, it's very firmly entrenched in its competitive market space. Historically, Coca-Cola has had some unpredictable free cash flows brought about with a constant reorganization of businesses and bottling operations. So we felt that a blended valuation was warranted. We wanted to take into account that Coca-Cola typically trades at a premium to its peers. We wanted to determine what was the real fair value for Coca-Cola. So the way that we did this was giving a 50% weighting to our DCF, a 25% weighting to our PE comp valuation, and a 25% weighting to our EBITDA comp valuation, which gave us the weighted average value per share of $57.70 and a weighted average price to value of 95 cents. Of course, this would be a little bit lower. This gets down the low $53 range at the close of market on Friday. And so we again reiterate our hold. For this pattern to continue, we would move into the buy territory as this valuation become much more attractive. And with that, we'd like to conclude our presentation and open the floor up for questions.
Since we're on the valuation slides right now, would you go into a bit more detail as to how you arrived at the discount rate for the DCF valuation?
Yes. There's a WACC slide in the appendix. Good. It's the one with the red headings. So we used weighted average cost of capital to calculate our discount rate. Because of the very low yielding debt, the cost of debt is actually quite cheap for Coca-Cola. Combining this, we actually only got a WACC of 5.7%. This was quite low. I think it was closer to 5.6% when we rounded. This was quite low. A discount rate of 5.7% is something that we do not use very often as an investment group. We felt comfortable adding 0.5% to that, demanding a little bit more out of our investment. But again, to take into consideration it is partially offset by the comp valuation that we did as well. I don't know who's first.
So several years ago, when I used to cover Coca Cola in the sector, if comparing Coca Cola with Pepsi, Coca Cola's advantage was always their global picture, where the majority of their business was outside the United States in faster growing areas, where Pepsi's was their faster growing portfolio of products. Has Coca Cola's relative advantage in the area of its global profile, have they lost any of that edge over the years versus Pepsi? Has Pepsi become more global? Have they increased their dominance in those areas? And is that as much of an advantage for Coca-Cola as it once was?
I still think Coca-Cola holds the advantage in worldwide operations because right now with the trend towards the healthier consumers, they're both diversifying their product mixes a lot. Like both of them have had many new product releases as well as like different acquisitions. And so I feel that with these acquisitions, a lot of them are very low margin businesses, but with Coca-Cola's like operations and their bottling being so efficient, they'll be able to improve the margins of those low margin businesses.
Yeah, and just from like a more global perspective, like yes, Pepsi has been growing as such as Coca-Cola, but we believe that Coca-Cola's brand recognition price like such a strong moat, especially in those markets, because being first, like you can also see it kind of like in their ad spending, right? Like Pepsi uses the Super Bowl to attract most of the North Americans, but Coke has the Olympics and has the World Cup, and like I'm an international student, and I can show you the presence that Coca-Cola has internationally versus Pepsi like does not compare at all.
Do you know what their mix is outside the United States,
So-
PepsiCo?
Yeah, so we're not projecting like the difference in like how the markets have been increasing, mainly because there's also a lot of like local international players that have been growing. There's a trend just in like consumers that they want to know kind of like the history of where brands are coming from. So like local companies with like a history of becoming bigger players. So for example, in the beer industry, there's a shift in, especially in Europe, towards more, what would be the right term to explain this? I guess domestic brewings are growing more than like the traditional mass-produced ones. So that there's an increase in everything that just makes it hard to quantify in each market how they're growing.
Question about the
So-
free cash flow yields.
Sure.
At 3%, it doesn't seem particularly appealing. How does that compare with their competitors, or how do you view that in terms of valuation?
The free cash flow, are you getting that from the tear sheet that we had?
Yeah, I think it was like 3% free cash flow yield, 3.5%.
Yeah, certainly not attracted by traditional measures. We didn't actually look at the free cash flow yield of its other competitors. When looking at the competitor space, our goal was to look at the opportunities for growth and how and which companies will be able to compound their competitive advantages. We would be more than happy to look into that and send you a report on that if you guys would like to add to that, I think.
I mean, in the consumer space generally, like there's this like rule of thumb where like a consumer retail cannot have more than like 25% market share in a specific region. Coke is the exception at like 28, I believe. So with that being said, like whenever you're projecting like entering different markets, we assume kind of like a cap at that 25% of the market as well. I don't know if that helps. Answering how we're projecting like the free cash flows and like the expansion on margins that you just mentioned in the previous question.
So if I'm a non-index investor and want to buy Coca-Cola, tell me about the dividend. I want my dividend, right?
Yes. The dividend is certainly attractive. I think it's declared 40 cents per share for all 4 quarters of 2019. The dividend yield is very attractive. The type of investment ideology, and you guys are free to comment on this as well, that we have, we typically don't consider the dividend when calculating the fair value of the company. That being said, Coca-Cola is starting to transition itself into a growth dividend yield type of stock, especially with the opportunities in emerging markets. So if that is an investment that attracts...
Do you have a growth target for your dividend?
We do not have a growth target for
Okay.
dividend, no.
Is the dividend sustainable long term?
We think it is, especially because Coca-Cola, and again, this is kind of touching on the investment thesis of they've divested a lot of their bottlers. Those are very capital intensive, capital demanding businesses. Our view on dividends is that we're perfectly fine with them if they believe that there's no better way to allocate capital to improve the business, which would further compound their shareholders' equity, right? But we don't think that that's the case, especially as Coca-Cola has transitioned to a more asset-light business model.
Sure. Going back to emerging markets, as you mentioned, it's a luxury product there.
Yes.
So, do you think there are profit margins and volumes would be an attractive opportunity there?
Yeah, absolutely. So to expand a little bit more on emerging markets, I'll talk about this. So the way it's working is there's a very rapid organization and globalization of what they call mega cities, right? Meaning that like cities with over like 10 million people are growing significantly, most of them in that like emerging market region of like Asia Pacific. But there's also a lot of cities that are growing past the 1 million mark, right? And they're all like very, it increases like the purchasing power per consumer, just the spillover effects of urbanization, right? Just like wages increase and then people have more money. As they have more money, it's been studied that one of the first things where they increase the type of luxury they spend is actually like on their food and beverages they consume. That's where like most of what they go towards. For the purpose of our study, it's defined that the middle class consumer makes at least $10 a day. So considering that I can expand, the amount of people that will be able to afford Coke after that should be tremendous.
So if they make $10 a day, are they going to spend $1 or $2 a day on Coca-Cola?
That's where the part of this is coming from. As they continue to grow on this what seems to be a luxury product is not really affordable to most of them. So what Coke is doing in order to be able to increase the availability of their product is reducing the price per unit. So hopefully kind of like reducing the gap between that aspirational consumer in the very bottom of that quartile that wants to be able to afford it, but also improving the profitability because technically each fluid ounce of Coke becomes more profitable. For example, if one Coke has 500 milliliters and it costs $5, we're just going to make the numbers easy, and they reduce it to 300 milliliters, if they sell it for $4 instead of $5, that each fluid ounce becomes more profitable. Like it just makes sense in that aspect. But
and adding to, if that is an attractive space, I certainly believe it is.
Yeah.
We read a report that talked about the shift in consumer spending, replacing basic food and drink with commercialized products. The largest increase in that is when income per capita goes from 2,000 to 3,000 per year to 10,000 per year. That initial jump is where you see the largest transition to replacing your intake with commercialized products. So we do believe it is a very attractive space.
Sorry, and the higher is at $100 a day, so there's a big gap. And the most volatility is at the bottom, so that's where it's expanding the most.
Judges, last question, please.
Yes.
Okay. So do you see Coca-Cola being impacted by a change in market sentiment? I mean, if you look at what's been going on in the market for a little over the last week, we've seen a risk-off trade going on right now. Do you see Coca-Cola as a potential beneficiary of that, and could that potentially or change in any way your rating on the stock?
Yeah, definitely. So right here we have the 1-1 stock chart, which you can see Coca-Cola kind of followed the S&P. So management did come out with a couple of statements about the coronavirus, and basically what they're expecting is a -2% to -3% impact on sales volume, but this is only in Q1, and they do not expect this to continue for the full year guidance. And then the organic revenue growth is only going to be affected by -1% to -2%, which also is only affecting Q1. So we think if this stock drops enough for us to buy it, I think you could buy it, and eventually, like later on in the year, the stock would rise back up, and I think it'd be a very good investment.
As value investors, we are attracted more and more by a larger number of companies with the consumer market. So I'm starting to see a lot of value in the rational stock. So Coca-Cola certainly is a company that would fit into that. We're comfortable with this business model. This is a company that we would like to own if the market for safety is sufficient. Thank you guys.